Paul Krabs, I've been a commercial real estate lender for the last 22 years, having spent this past 10 years with Wells Fargo. He doesn't need much of an introduction around here. Thank you, Paul.
All right, try to make some color of this. So the title of my presentation this morning is A Canary in the Coal Mine. But first, a few acknowledgments to some people that gave me input in the presentation. One, Jim Sellers with CBRE, Steve Odenkirk with Paradise Commercial Finance, and Cindy Hammond with Churchill Commercial Capital. Okay, I got 5 minutes, so I got to fly fast so I can land. The CRE debt market. So what you see here is $2.5 trillion of debt in the CRE debt market. The largest holder is banks and thrifts at 36%, followed by the CMBS market at 22%, and the agencies and then life companies at 13%. Just a little footnote, the CMBS market over the last few years has obviously been shrinking in terms of outstandings. Most of that gap has been made up by the life companies and the banks. Life companies today, what we're seeing is leverage points in the 60 to 75% area, a preference strongly at 65% and lower, rates in the low fours. These folks are doing 20 and 30-year terms on product. Outside of the agency platforms for multifamily, this is the longest term debt you can get for commercial real estate. Lending in all the major food groups, offering interest only in some loans, strong preference for a product, Class A product in A locations. The one advantage they have over many others in long-term world is that they offer opportunities, are more friendly to modifications during loan term. The banking industry, loan sizing is higher than life companies, but it's being generally constricted by debt yields, and those are typically in the 9 to 12% range. And for those of you who are not familiar with that, it's basically the net operating income of the property into the loan amount. Rates in the low fours, strong preference on term of 3 to 5 years. Interest only depending on the story. And here's an interesting note that in the major markets, there's a lot of spec financing going on, and now we're starting to see it in the secondary markets. Some conversations amongst the banking circles as to whether we're starting to approach another bubble. And I know some in the room may not feel that way given where we are in the recovery, but there are other markets that are starting to have those conversations. The CMBS market, 70 to 75% leverage. Rates again in low fours. 10-year term is the most popular, 25 to 30-year amortization. And a lot of these are having interest only in them. Almost 2/3 of the originations that have been sold over the summer, the pools have included interest only components. The CMBS market, one of the disadvantages they continue to struggle with is that they're perceived to have a difficulty of modifying during the term, less flexible. So why is that? Let's talk about that. The CMBS funding pools are basically loan pools sold to a group of investors in the Wall Street arena. And these buyers are organized into risk layers from AAAs that are getting spreads over swaps of 75 to 85 bips to the higher risk end of that stack of the BBBs, which are getting about 315 basis points over swaps. Now looking at the B-piece buyers, it's interesting to see that these folks are spread across only about a dozen firms when I was doing the research on this. And a number of these players are the same people that were in the B-piece position, maybe different chairs, different companies, at the last market downturn. They're still involved in the industry. And about a handful of these B-piece dozen firms make up most of the B-piece buying. This is important because the B-piece part of the CMBS market basically does a lot of the underwriting. There's the rating agencies that do the ratings of these pools, but the B-piece players are critical, and it matters. Their underwriting is big, and it matters a lot to the AAA buyers because even though the AAA buyers make up about 2/3 of the CMBS money that's flowing into that market, they're relying on the B-piece buyers to do their underwriting for them. And so they're closely aligned to some of these characters over time have been relationship and closely aligned. So they're kind of like gatekeepers, these B buyers. The B buyers hold a trump card. They can kick out any loan based on its structure or the product type, depending on what the loan pool looks like. And just as it's riskier to be the B-piece buyer, they obviously would get what? A higher yield for that risk. And that's kind of called a risk differential, and that spread is actually quantified. You can look at it. And I took a look at this spread, and it's currently, obviously, it's about 240 bips. And the interesting thing to note on this is that B-piece spread differential is compressing, and it's compressed quite a bit over the last 18 months. We saw this before. We saw this spread compression before. And we also saw about 2/3 of the CMBS pool starting to have the interest-only component. We saw this before. I think you all know about when we saw these things. So these are kind of things to watch. So basically, ladies and gentlemen, I want to introduce to you the canary in the coal mine is the B-piece buyer. And some people may say, Paul, wait a minute, the underwriting for this product type is changed and upgraded given the Great Recession experience. But I'll leave you with the foremost and dangerous words in investing are, this time it's different. Thank you.
Thank you to all our speakers. 4 things real quick. Last quarter we introduced the deal of the quarter. Unfortunately, not once but twice we had something lined up and speakers bailed on us, and I'm not going to bore you with why, but we hopefully will have it on the 4th quarter. Secondly, we will get Chris's slides on the website for members. Keep in mind, you can always go back to the website. We video these presentations, so you can always do that. And so, lastly, our next meeting will be the 20th of November, and we haven't chosen the topic yet, but it will be something good. Thank you very much for coming.